All investors seek to benefit from market opportunities at the lowest cost possible. To do so, many have turned to margin accounts to help them in the process. Buying on margin consists in purchasing securities through borrowed funds. A brokerage margin account can provide you with a bigger gain when your holdings appreciate. How? Let's take a closer look at the inner workings of a margin account to see how leverage can benefit you. A margin account allows you to borrow part of the value of the securities you wish to purchase. You can therefore buy more shares than you normally could with only your accumulated capital. Buying on margin is not without rules. For instance, current regulations do not allow the financing of the entirety of a purchase with a margin account. You must make an initial margin deposit called the minimum margin requirement. This amount varies depending on the type of investment you want to make. To illustrate, let's say you wish to purchase a stock at $5 or more. You would have to deposit at least 30% of the total purchase price, and your broker could finance up to 70% of the total cost of the transaction. For stocks that trade between $2 and $5, you can obtain financing for 50% of the total market value. Note that it is not possible to borrow from a margin account to purchase stocks with a market value of less than $2. In the case of other asset classes, the minimum margin requirement also varies depending on your investment. And as is the case of stocks of less than $2 in value, some products cannot be financed with a margin account. If the value of the shares purchased via your margin account drops below a predetermined level, you will receive a margin call. This means that you must replenish your account, either by selling your stocks or depositing a certain amount, in order to cover the minimum margin requirement. A margin account gives you the opportunity to purchase more shares than you could with a cash account for the same down payment. If you make a profit on your investment, it will be amplified because you will have increased your purchasing power. That's what is referred to as leverage. For instance, let's say you wish to purchase 1,000 shares at $10 each, because you believe that this stock is about to increase in value. This transaction would require an investment of $10,000. Since you need to provide a minimum deposit of 30% to purchase securities that trade at more than $5, National Bank Direct Brokerage would finance 70% of your total cost. In this case, $7,000. On your end, you would only need to invest $3,000. Assuming the stock price moves to $14 and that you sell your shares, you will have realized a gain of $4 per share for a total of $4,000. Considering that you have only invested $3,000 for them and that you must repay the broker's loan of $7,000, this constitutes a growth of 133%. If you had invested the full $10,000 yourself, this growth would have amounted to 40% relative to your initial investment. It's also important to consider the potential downside of using leverage. Assuming that the stock price drops to $6 and that you sell your shares, you would have realized a loss of $4,000. Considering you have paid $3,000, you would need to deposit an additional $1,000 to cover that loss. This means you would have experienced a loss equivalent to 133% of your initial investment, compared to a loss of 40% if you had not borrowed funds to make that investment. As you can imagine, margin investing is not something every investor can nor should consider. You must have an excellent risk tolerance, a good understanding of stock markets, and sufficient cash assets to handle fluctuations. Yet, if you make an informed decision and thoroughly research the securities you wish to purchase, you could make a very interesting profit. Do you have questions? Visit the Education Center of our website at nbdb.ca or call us at 1-800-363-3511.